Hi, Sam from Teach the World to Trade. Welcome to this first module in the Foundation series to help you develop that healthy, sustainable relationship with the markets. Markets and trading, it's not casino stuff, it's not gambling, it's not betting, it's not the lottery. It's a structured approach and a skill set to give you an advantage to make money from the markets. Hopefully, this foundation course is going to set you on your way to improve yourself as a trader and a market participant, to help you on your way to succeed and maybe even change your life through trading. So enjoy and good luck. Let's take you on this journey to improve your relationship with the markets from the ground up. A little look at the course outline. This is our introduction to markets, given some basic principles of the markets and how you should view them and how professionals view them. Then we're going to look at direct market access, risk management, the professional trading process, fundamental analysis, technical analysis, trade execution, trade evaluation and the golden rules, trade psychology, and then we'll go through a course recap and next steps. This is all essential, must know, need to know foundations of trading to give you that base to then move forward into the markets and hopefully succeed. When we talk about the markets, I'm a multi-asset trader and I always have been. Over my 20 plus years of trading, I've traded hundreds of markets, single stocks, crypto, more recently DeFi, and lots of traditional markets. We're going to go into some of them individually as we go on and throughout the course. But there are a lot out there. I don't expect you to know anything or everything about them, but you just need to know there's a lot. And we will take them one at a time when we can. But first of all, we're going to bring it back and look at what's the type of market, because there's a few different ways to trade all of those different market segments that we spoke about. Futures, options, shares, single shares, which most of you have probably heard about, the most popular one. The physical market, spot and cash market, OTC, which is over-the-counter market. Then you've got crypto, and then spread betting and CFD, which are heavily advertised markets for retail traders or newbies in particular. I've got extensive experience in futures. That's almost the trader's type of market of choice, and there'll be a lot of focus on futures going forward. And obviously, we're going to talk about the other markets as well, shares and crypto in particular, because these three, I've done my research, are the most likely entry points for you as traders: futures, shares, and crypto. But everything we learn and we talk about can be taken to any market. So what is a future? The textbook definition is a future. It's a legally binding contract, which is an obligation to deliver or take delivery for a fixed quality and quantity of an underlying asset at a fixed price on a specific date in the future. Okay, the key things are there. We do call them contracts. They're futures contracts. And in that contract is that legal obligation to deliver something or receive something at a certain fixed price. Okay. But when you're buying a future, you've got two options when you look at a futures market. You can buy a future, which is called going long. It's your first bit of trader lingo, going long. The buyer has two choices. You receive that underlying asset from the futures exchange when the contract expires. So this is called taking delivery. Or you sell the future before it expires, offsetting the position, which this results in a profit or loss. This is the one that we focus on as futures traders. It's very rare that people take delivery of what we call the underlying asset. I'll explain what that is in a minute. You basically want to get in and out and then offset the position, resulting in a profit or loss. Because the opposite is going short. So that's the good thing with futures. You can either go long or you can go short very easily. So going long, you think the price is going up and you buy a future. Short, you think the price is going down. So you sell and go short. So the seller has two choices when they're short: either deliver the underlying asset to the futures exchange, they make delivery, or they buy the future before it expires, offsetting that position and resulting in in P&L, plus or minus. Okay, going long is buying, going short is selling. Futures, why do they even exist? The use of them, the main use, one of them is the risk transfer. So hedging, we call this, another bit of lingo. A primary function of futures market is hedging, so buying and selling futures to offset the risk of changing prices in the underlying asset. Price risk exists in virtually every type of business. Tons of examples of this. The main one and the kind of the very reason the futures market exists is the price of crops fluctuate in relation to factors such as weather or transport costs. And then manufacturing, risk from labor problems or tax law changes. Banks and other financial institutions are at risk due to fluctuations in the price of the underlying asset that they hold, be it interest rates, bonds, etc. The value of equities and bonds are constantly reacting to the forces of supply and demand. Prices going up and down, essentially. So hedgers use those futures. They're easily able and efficiently transfer risk to speculators and other hedgers. Okay, so quick story about the origin of futures. It's supposed to be rice farmers in early ancient Japan, where a farmer would have his crop of rice and he knew the price of rice today and he would like to lock in that price in the future. A speculator would have made a deal with him and said, well, there's a lot that can happen. So time is kind of, and duration is expensive because anything can happen in those times. So if you've got a crop today that is going to be cropped in 3 months, anything could happen in those 3 months. So as a speculator, if I was taking the other side of that trade from the farmer who wants to hedge his position, I'd say, well, there's got to be a price for that. The price the risk is up and down, but I'd probably want to assess the situation and say, right, if the price today is 10 and you want to lock in 10, we could have bad weather and the crop could be lower, so the price could go up and I'd benefit from that, or we could have a bumper crop and the price would go down. So I've got to assume that risk. So I'll give you 8 instead of 10. The farmer's happy because they've locked in the price and they can then determine their P&L and their business moving forward in that time. And the speculator's happy because he has got the opportunity to then make money in that 3-month period until the crop comes to fruition. I've jumped the gun a bit and told you about speculators. They're taking the other side of the hedger and the speculator. They fulfill several vital functions as they facilitate the marketing and trade of futures. Speculators don't create risk, they take it on. And that speculator is taking it from the farmer, from the hedger, and other market users, so in the hope of making a profit from subsequent market fluctuations. What the speculators have done is provide liquidity. This is an important word in trading, liquidity. In a market without these risk takers, it would be almost impossible for hedgers to agree on a price. As sellers want the highest price, well, obviously buyers want the lowest. It would not be cost efficient to find offsetting hedges all the time, so speculators bridge that gap between the bids and the offers, the buyers and the sellers, thus making the market more efficient. Speculators increase the number of ready buyers and sellers, and that's us as traders. We're helping improve that liquidity for those who want to hedge their positions. But we're doing it. You've got to speculate to accumulate. Any market type you enter will be for the same reasons, be it options, stocks, futures, crypto, to make a profit, which is trade, or de-risk another position, which is to hedge. Risk. You've got to understand risk from the get-go. Trading risk, there's many forms of risk, but trading risk can be defined as the exposure to mischance or loss. In investment terms, it is the possibility that one will lose money. This possibility is higher where the returns are greater. And this is something we all have to understand when we come and trade the markets, that there is a chance to lose money. We're obviously in it to gain money, and that's why you need a good foundation and to understand the process and principles and discipline and philosophy of trading, which hopefully we're here to teach you. A primary feature of futures and options is they can be used to diversify away risk in an efficient manner with lower transaction costs. Portfolios of stocks can be hedged with index futures, bonds risk with bond futures, and money market risk with interest rate futures. Futures and options can be seen as tools for the following risk management: market risk, credit risk, operational risk, legal risk, and liquidity risk. So whereas as traders we take on the trading risk, which is that exposure to mischance or loss, Other forms of risk can be de-risked using futures and options. Benefits of trading futures. One of the key ones is leverage. So a primary feature of trading those futures contracts is the leverage or gearing that occurs. For a small sum of deposit, we call this a margin. A trader controls a significantly greater valued asset, measured as a percentage of the capital invested. The profit or loss potential for futures contract is much greater than a similar investment in the underlying asset. Liquidity, this is very important as well. It refers to how difficult or easy it is to trade a particular future without changing its price significantly and in the quantity that suits your purpose. A liquid market has large numbers of buyers and sellers and small bid offer spreads. And these are key characteristics that you need to look out for when you're going towards a market that you want to trade. How easy is it to get in and out without affecting the price of that market? And the open interest is often a mark of this, which is the number of outstanding contracts in a particular future delivery month for a specific future, and it can be viewed as a measure of liquidity as well. So we always look at the open interest and we look at the liquidity of a market before we trade it. Contract specs. Now these are designed for the market by exchanges. We'll look at those in a second to determine what is best for the market. So for an example, one Brent contract is equal to 10,000 barrels of oil. So when you're trading one Brent futures contract, the underlying asset that it's based on is 10,000 barrels of oil. So instead of having to buy and sell 10,000 barrels of oil, you go to the futures market and you can trade one contract, which is the equivalent of 10,000 barrels of oil. One SONIA contract, which is a UK interest rate product, is equivalent of £1 million worth of debt. Contract specifications continue. Tick size, super important. Things move in ticks. Our lives are governed by ticks as traders. So tick size is the minimal price fluctuation of a market. For example, the FTSE moves in, we call this half ticks, 0.5 of a tick. And the bund moves in small ticks, in bips. We often call this, in FX, call it pips or basis points. But ticks is kind of the universal name. And the bund moves in 0.01 ticks. Each tick has a value to it and each market is different. This is absolutely the kind of stuff you need to understand before you start trading any market. So how much is made or lost per tick movement? So one tick up, if you bought and sold for one tick, how much would you make? And this tick value is assigned by the exchange. For example, Brent is $10 per tick. And SONIA is £12.50 per tick. For each price move up or down, in Brent, $10, SONIA £12.50 sterling. And then European products are priced in euros, Japanese in yen, for example. But you have to understand these tick values and tick sizes for any market that you're going to enter. It's also important to understand the delivery date and the last trading day of any contract that you're trading. Delivery date. So obviously we're trading into the future. An opportunity arises in the price now, speculating what the price will be in that future, in the future months. There's monthly expiries, quarterly expiries for these futures, understanding when that expiry is and the delivery date is. So you're not trading right up to the end. Your broker will generally let you know this so you don't take delivery or have to deliver any of the underlying when it comes to the delivery date and the last trading day. So the last trading day is the last day you can trade that contract unless you take delivery. And again, there's robust systems for your broker and your clearers that make sure this doesn't happen. Now, the exchanges, we've mentioned them a couple of times. You know, we've got ones like the London Stock Exchange, the New York Stock Exchange, which is actually owned by ICE, which is Intercontinental Exchange, and the CME. These are the two biggest futures exchanges. ICE over here in Europe, the CME over in America. You've got Euronext, which is over in Germany, SGX, which is over in Singapore. That's the Singapore Exchange. And then you've got the newer, your crypto exchanges, Binance and Coinbase. These companies, they act as a marketplace in which securities, commodities, derivatives, and other financial instruments are traded. The core function of an exchange is to ensure that fair and orderly trading via the use of standardized contracts, as well as efficient dissemination of price information for any securities trading on that exchange. The exchanges give companies, governments, and other groups a platform to sell securities to the investing public. An exchange may be a physical location. There's still a few physical trading pits left. If you go and have a little look on YouTube for trading pit or trading places final scene is one that I always used to show people, and it will show you the old school trading pit where people are shouting at each other trying to get deals done, and all the financial markets were centered around physical spaces. Now it's 95% on electric platforms, I'd say, maybe even more. An exchange doesn't set the price of the market. Rather, supply and demand determines those prices, those market forces, we call it. The exchange has nothing to do. It just provides the opportunity to trade products transparently and legitimately online or in a physical location. This is a little chart of how things have changed over the years. In the 70s, the futures market was heavily agriculturals, and a lot of physical markets. And today, and probably the future, it's more financial based by quite a long way. Interest rates, equities, FX. And then we've got crypto derivatives as well that are making a headway in the past 4 or 5 years, which could reshape the financial landscape going forward. But proof will be in the pudding. It's yet to be seen. Exchanges today, so reducing the cost of transactions has been absolutely key, and getting that access worldwide. It's one of the reasons why I have set up Teach the World to Trade and brought my professional institutional grade of teaching and training and coaching to the retail market, because it is now easier than ever to access traditional markets because the costs have been reduced. Technology is advanced. There's greater liquidity. There's greater competition. And part of that competition is getting more people to trade more markets. Increased transparency. There's tighter spreads, due to that liquidity and more participants. And then from the exchanges, you have to have a clearer. There's normally another middleman before you get to the markets with the exchanges, and that is normally called a clearer. And they deal with things like margin, any deliveries, any day-to-day settlements of prices, your trading statements, so you know your P&L. But your online broker connects you to your clearer, or is your clearer these days, unless you're moving to a more professional setup where you have to set up your own clearer, and then you're plugging straight into your clearer and then to an exchange. That's how we do it in the professional, in the industry. But for your starter, trading at home, moving from understanding to then trading, your online broker will be doing it all for you. Okay, let's have a little taster of the markets. I group them into 3 easy categories. Capital markets, because money makes the world go round, essentially. You've got your FX, which are your currencies, your bonds, which is government debt, interest rate markets, stock indices, and you can have single stocks in there as well. Precious metals, gold, silver, copper, and crypto. I've put crypto in there because, this could be the future of money. Then you've got food, because everyone's got to eat, right? Wheat, sugar, coffee, cocoa, cattle, lean hogs, soya beans, corn, milk and cheese. We even have milk and cheese futures because they're huge markets. And that there's that hedging and offsetting has to be done somewhere. And a lot of that liquidity has to come to the futures market, which creates those opportunities. And then energy. We all got to keep the lights on. Brent crude oil, West Texas Intermediate oil, which is over in the States. Brent crude is the Middle Eastern standard. Natural gas, because we've got to keep the heating on. Heating oil, because it gets cold in winter. And then you've got RBOB gasoline and gas oil, which are petrol derivatives. And there's many, many more. These are the ones that I've got vast experience trading. I know there's a lot there, but I've been in the game over 20 years. And these are the ones that I'll focus on there or thereabout for this course. Okay, finally, you've got to think. Start thinking what are futures and why you'd want to trade them. Think about the trading vocabulary that has come up and what markets interest you. This is most important because this starts you on your road to trading. Because if you want to become a trader or you want to invest and you want to be involved in the markets and create that sustainable, disciplined relationship with the markets, you've got to find a market that interests you because you're going to have to know it inside out. Okay? That's the end of module 1. Thanks for your time. Looking forward to seeing you module number 2. Take care. And as always, stay lucky. So that was the first module, Foundations, where we spoke about some real core basics of the markets that you need to understand before you even start clicking a mouse and getting involved in the markets. We sprinkled some knowledge on risk, which is one of the primary components of trading, and understanding that trading risk, that you have a chance to lose money at the end of the day. Purpose of this course is to hopefully save you some money in the first place by giving you that foundation that you need to enter the markets, and then B, get you close to your goal, which you'll be trying to make some money through the markets. Okay, so if the markets are a risk transfer system, you got to think, what side do you want to be on? Okay, I'm Sam at Teach the World to Trade. Look forward to seeing you on the next video. Stay lucky.